Good morning from our global headquarters in New York. I'm Menace Rennie alongside Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Countdown to the ECB. Rate cuts expected, but just how guarded will the guidance be? A banking crackdown yet again. China detains top investment bankers and asks others to hand in their passports. And a fresh cash injection. OpenAI to seek billions from investors, boosting the firm's value to $150 billion. Good morning, Manus.
Danny, good morning. The 50 basis point rate cut might have been knocked off the table, and that actually was taken quite well by equities, up over 1%. Nvidia, it was the tech market that really sort of brought a tailwind to the market. So 50 basis points off the table. Methodic, slow process. Good news for the equity market, not so much for the bond market. Twos ratcheted by 9 basis points. So this bond market had perhaps a little bit overextended itself on the pace and trajectory of rate cuts. $30 billion worth. Our 30-year paper comes to the market today. We're counting down to the ECB. Goldman Sachs have just cut their neutral rate. We're flat at the moment. 110 is where we stand. So it seems as if there was relief in the equity market on the jumbo cut going and disappointment in the bond market. Danny, good morning.
Good morning, Manus. Even so, with the equity market doing okay, it didn't seem to start out that way. It was down 1.6%. It reverses to up as much as 1%. We're in this environment now where we're almost having cycles within one day. This from Bespoke. The last time the Nasdaq was down 1% and finished the day up over 1% was October of 2022. But Manus, back at that time, it was the bear market low. So this thing kind of tends to happen when you have regime shifts.
Yeah, and it not just that, but I think yesterday was one of those days where it really was fill or kill for the bond market, which is we needed the data to fill the order to deliver the 50 basis point cut. We just didn't get dovish enough data for us. And that is where, the equity market breathed a sigh of relief. No 50 basis points, so we're not in crisis.
I mean, at first it seems like crisis, but maybe there also just
growth scare.
Well, I mean, there's this idea of like if the inflation risks have abated, which is what yesterday's data. Yeah. I mean, it did show, even though it was a little bit hotter, why mess around with 25? Why not go 50? Maybe it's not the economy that's moving the Fed to go 25, but just precedent and this idea that they want to move slow and carefully because it helps with their credibility and for cycles to come.
So it's going to be doubly interesting then today with where Lagarde's guidance goes. It is ECB day. The assumption is 25 basis points. Another cut. They've come back from the beaches. They'll go for 25 basis points, but what will the guidance be?
Yeah, and Europe's economy, by all accounts, is much weaker than the U.S. Growth looks anemic. Germany is facing VW plants shutting down. They can't agree on EVs. Draghi's calling for more spending. And yet we're just talking about 25, and we're uncertain where they go after that.
Yeah, the wages numbers have come down, and that's possibly a big element for the ECB. But let's talk about Ludovic Subran. He's over at Allianz. He's looking past the ECB and weighing in on the Fed's decision next week, writing this. We expect 3 consecutive 25 basis point cuts in September, November and December 2024 as the Fed balances out a softening of the labour market and a still resilient economy, followed by another 5 rate cuts in the first half of next year, taking us to 3.5% by July 2025. He joins us now. Ludo, good to see you this morning. We'll come back to your neutral call in just a moment. The CPI yesterday snuffed out the 50 basis point cut. The market still sees 140 basis points of cuts by the start of next year. Are jumbo cuts just delayed and not denied?
I personally think jumbo cuts are not warranted. Why would you use 50 basis cuts when you are in the midst of an election and anything could be seen as a political move, when you still have some pressure points on the overheating risks of the economy, especially on the labor markets? And to be fair, you have plenty of time between now and mid-July to go to a terminal rate of 3.5. So for me, we ruled out the jumbo cuts very early on. I think it was part of one of these, market testing the waters a bit. But yes, the question will be if there is at one point a downside risk to the soft landing narrative. I think the Fed won't hesitate either. That's certainly sure, because remember, 25 is a very critical year when it comes to the real estate sector, when it comes to private equity, when it comes to a lot of these private assets that have been suffering a lot all through this year.
Ludovic, Jan Hatzius over at Goldman does agree with you, says that it should be 25 basis points. Yesterday only solidified that, but said that the market is overthinking the ability or the likelihood that the Fed has to respond to weaker data and instead is not discounting enough the odds that the Fed cuts 25 and then has to stop because of an inflationary spike or just strong growth in general. Ludo, do you think that is a risk that the market's discounting that the Fed cuts 25 and has to pause in its cutting cycle?
Of course. I mean, again, we talked about that, I think, last time. In our scenario, there is still a flip of a coin between Kamala Harris and Donald Trump. If Donald Trump were to be reelected to the U.S., he's very inflationary. And so I think that would cause the Fed to stop, right? And that is the loosening cycle, that is. So for us, for example, initially we thought, okay, the next FOMC is 3 days after the election. That would be anyhow a pause because we know it's going to be a contested election no matter who wins, right? So we were a bit in the camp that maybe they should front load. And I think that's what the market is getting to grasp with, and that's why they tested this 50 bits. Now it looks, maybe because of the polls also, that there's going to be a very gradual loosening, which is really what the U.S. needs today. This is the forward guidance 101. This is getting away from data dependency, which was really a mess when it comes to how markets reacted to this. Look at the bond volatility. And to me, I think that's why it's switching. The odds are going back to something much more orderly than trying to get something through. Because indeed, were Trump to be elected, there is a risk of inflation picking up again very strongly in 2025 in the U.S., right? So now what is out there is at least 75 basis points till the end of the year. And then, 25 is the big question mark. For us, it is these 5 rate cuts that Marcus showed. But it is really a question mark because Trump could actually bring back tariff inflation, labor inflation, and certainly also the devaluation of the dollar is a big issue when you think about how much import inflation could bring to the U.S. So that's what markets don't know much about because nobody knows who's going to win this election.
So you lay out the board of risk very, very clearly. But if we take that forward, you talk about an orderly, progressive cutting cycle, which will be interrupted pretty much either way for you. What does that do to the bullish positioning in this bond market? Because this bond market has really hung its hat very much on the bullish side.
Okay, it's very interesting because I think the bond market has been regime switching almost every 3 weeks since the beginning of the year, and we've seen very bearish moments and we've seen very bullish moments. I tend to be on the bull side now for the bond market. So I think now the big question everybody should have in mind is what does a big yield curve disinversion means? Especially for stocks and for bonds. I tend to be long bond. We looked at the past episodes of US yield curve disinversion without a financial crisis or with a mild recession, and people tend to be very, pro-equity. I think this is a bit of a mistake because usually there are corrections along the way. I think we need to be long bond, and this is something that is, the right positioning right now if you look at what market is expecting.
Ludo, we have to talk about the ECB decision. I think some people would be forgiven to ignore it somewhat today. They're expected to go 25, but the European economy looks anemic in terms of growth. Germany is struggling to keep its head above water. China isn't lending it any support. But you still have the hawks saying that an inflation uptick is a risk. Are we going to get any guidance whatsoever from Christine Lagarde with those two very clearly opposing camps?
It is indeed a catch-22 for the ECB, but mostly because we are in fiscal season. And as you know, from France to Italy to Poland to, Poland is not in the year, but these are countries that are it's a very interesting moment for fiscal policy and consolidation. We've seen the Germans showing the way, including their response to the Draghi report, right? So I think the ECB has to cut this week. They may pause and cut again once, and then come in with a series of cuts in 25 to reach 2.5 by middle of next year. But they have to be gradual because they don't want to give in too much. They want to also get a bit of, reserve or get a bit of something in their, dry powder type of, because we are concerned, all of us. The momentum seems to be okay-ish in Europe because of real wage growth. But 25 is a big question mark, especially on the German economy, which is, again, growing zero, but also on the uncertainty on a lot of political landscapes from France to Italy to Spain. And so I think the ECB cannot yield in to the pressure of saving the day too early. when there are a lot of signals that need to come from Berlin, from Paris. And I think that's where they need to be apolitical. And so that's everybody's looking at how they're going to handle the soft patch. The numbers are, again, looking slightly brighter towards the end of the year. But structurally, we have, this slow agony risk that Draghi mentioned very vividly during his press conference for the Draghi report.
Ludo, I love that phrasing. They can't save the day too early. We're going to get that decision in just over 3 hours' time. Ludo, we always appreciate it. Ludovic Subran of Allianz. Manis, let's get some of the other top stories that are trending on the terminal this morning. OpenAI is in talks to raise another $6.5 billion in equity financing from investors that would put them at a valuation of $150 billion, a significant jump than what they were at earlier this year when the company's tender offer put them at $86 billion. This all now puts OpenAI among the 100 most valuable companies in the world.
Norfolk Southern has fired the CEO, Alan Shaw. The decision comes after an investigation found he violated company policies by engaging in a consensual relationship with the chief legal officer. The CFO, Mark George, will be appointed as the CEO and will join the board.
This is Bloomberg Brief. Danny Berger and Manis Cranny in New York. China is tightening its grip on its financial sector, detaining and taking passports of investment bankers. For more on this, let's get to Bloomberg's Jill Desis in Hong Kong. Jill, before it was China saying, curb any pay cuts, rein in belt tightening. This seems like quite the escalation to take passports and detain bankers. Why?
Yeah, that's right, Danny. So as you mentioned there, I mean, this has really been going on for the past few years, this sort of broader anti-graft austerity measures that China has really taken in regards to the financial sector. But it does really seem like it's escalated a lot recently. So we're reporting on the detention of 3 top investment bankers, at least over the past few weeks. And then this guidance that's apparently gone out to a lot of these state-backed brokerages, which is basically, take your passports from, a lot of their investment bankers, make sure that all of their travel overseas is pre-approved. This coming after one particularly high-profile case involving a major investment banker at Haitong, that's a Shanghai-backed securities firm, who was detained overseas and actually brought back and repatriated to China. So what it seems like here, too, is that these investment banks are also just monitoring the activity of a lot of their investment bankers a lot more closely when they do take overseas trips, if those are approved, making sure that they can't do anything outside of whatever is on the pre-approved itinerary. And one thing that I really want to make very clear here, Danny, is, this is China. As we know, the Communist Party top government officials have a lot of, influence over a lot of what's happening at these state-backed firms. But in the past, we've really only seen this kind of passport confiscation happen with really, really, really senior level, top level bankers. The fact that this is trickling down into mid or lower level investment bankers is what is really defining this larger push, this larger anti-graft crackdown here.
Well, it certainly brings back memories of the big crackdown on tech, and that lasted 18 months with some significant, downsizing in the industry. What is this actually going to mean for the brokerage industry?
Yeah, so Manis, I think this is pretty critical here. So this is a $1.7 trillion industry in China, and I think it's really kind of taken on a lot of renewed importance, particularly over the last year. So Manis, it was just last year that China actually changed more significantly some of the rules around its IPO market. So previously, it was a sort of a registration-based system where you had to, or a regulatory approval-based system where you had to go through regulators, and it was kind of this complicated process. So in the name of reform, China actually tried to open up its IPO market, say, we'll make it more of a registration-based system where you go and work with brokerages, get underwriters for your IPOs here. So what it seems like is that China is actually stepping up a lot of the regulatory overview over what they're doing, trying to root out any corruption, and what they see is this industry that's really heavily involved with this market that, as we know, has been struggling, particularly during the economic slowdown. So what this ultimately means for the industry at large, we'll have to see. But I think, as you just pointed out there, Manis, we've seen a lot of similar types of crackdowns in all kinds of industries within China, whether that's tech, whether that's education. So at the very least, we're seeing right now kind of a chilling effect impacting some of these firms.
It's another round of the common prosperity change implemented by Xi. Jill, thank you very much. Jill Desis in Hong Kong. So let's stick with the China theme. The government has strongly advised car makers there to make sure advanced EV tech stays in the country. What exactly does that mean? Oliver Crook is tracking this story. Oliver, it's almost like ironic. The US is desperate not to let high tech into China. And here's China telling their EV makers, don't let the tech out of the country. Put the context around it for us. Good morning.
Yeah, that's right, Manus. I mean, how much the times have changed has been historically, that's the fear, is sending tech into China and then the IP maybe not being respected. Now we're seeing the opposite happening with China, who is so far ahead on a lot of this EV technology. They have advised the car makers to not necessarily send their advanced EV technology. And when the Chinese government advises companies to do certain things, it comes with a little bit more potentially than advice. So they said that you should be very wary. Potentially, for one thing, they don't want any of it, any production to go into India. That is interesting. But even the reason this is such a relevant conversation is with all of these trade barriers coming up, these companies are looking to build production in local areas and in Europe, in Turkey, in Spain, in Hungary. They have plans to go plants all over there. This is the Ministry of Commerce saying basically maybe pump the brakes. And if you do build things in there, maybe send out knockdown kits, which is basically where you compose a lot of the critical tech within China, ship that out to the factories and assemble them locally. The problem is, of course, there are rules around that. In the EU, for example, you can't just do that. You need to create a certain minimum value of the car locally. So this is going to be part of the sort of ever complicating tariff debate that we're getting here in Europe and with China.
Well, I mean, it really dampens prospects for Europe coming together to be able to establish anything together. If something as simple as EVs with China, I say simple, but it is something that there seemed to be agreement with in the EU. You had Spain's prime minister in a trip in China saying that they oppose the additional tariffs on EVs. And now Germany is joining in on that. Well, what is happening, Oliver?
Yeah, Danny, this is really interesting, and this is really bad news for Ursula von der Leyen in the EU, as they have just this new commission, which hasn't even been founded yet, which comes into power in November. Basically, they have come together with a sort of consensus to impose these tariffs on Chinese EVs that come into the country. The Germans, by the way, have always been kind of opposed to this, but they sort of fell into line. Now you have Pedro Sanchez coming in saying, we're not sure this is such a good idea. That has sort of emboldened Scholz a little bit to sort of double down. And the reason, of course, for the Germans is they ship a huge number of the really luxury, high-margin cars into China. For the Spanish, this is also the tit for tat. The Chinese are thinking about putting tariffs on, dairy products and pork. Guess what? Spain is the biggest exporter of pork over into China, so it's squeezing them there. Not only that, I mean, there's also the question of solar panels, right? Spain has a lot of sun. The solar panels that are made very cheaply are all made in China. Maybe Spain wants those to come in, but again, where this is really significant, Danny, is the point you're making, is you're starting to see fragmentation and consensus just eroding here in Europe among these countries as you get this new commission coming into power.
Yeah, it does not bode well for challenges that Europe's about to face. Oliver, we appreciate it. Bloomberg's Oliver Crook there on Bloomberg Brief.
It is Bloomberg Brief. I'm Manus Cranny alongside Danny Berger. Front pages for you. This is what we've got making the headlines around the world. First up, the family behind the luxury brand Chanel and the billionaire heiress of L'Oreal have bought a stake in the fashion label The Row. That was founded by the Olsen twins. The deal values The Row at $1 billion.
Next up, the Financial Times has this. The IEA is out with a new report that oil prices are going to keep falling. Demand is weakening. In fact, it's its lowest since the pandemic. But producers continue to pump volumes that exceed global demand, even with an OPEC Plus keeping their cuts.
And UniCredit revealed yesterday that they'd now built up a 9% stake in Commerzbank. That adds all the shares that Berlin offered this week to a position it had quietly built in recent weeks. And speculation of a possible sale mounted. UniCredit CEO Andrea Orcel spoke to Bloomberg about the move in the last hour.
The ultimate goal is what everybody talks about. Europe needs stronger banks. Europe needs cross-border. Europe needs banks that are capable to support its industry and the development of Europe so that we are an economic bloc that can hold its own against the US and China.
Andrea Orcel there speaking to Francine a little bit earlier on. It's interesting, he said, we went to the government, we said, and to quote the phrase I used earlier, fill or kill, give me your stake. or we walk away.
But see, this is the weird thing, is because the German government came out and said, we were surprised that UniCredit built this stake. If you listen to Orchel, he literally said, how could they be surprised? They knew we had 4%, and they themselves sold us another 4%. How could this shock them?
Exactly. So it's two different sides of the story. The issue is going to be the labour unions. The Labour representative came out this morning and said, actually, you know what? We prefer to tie up with a French bank rather than an Italian bank. No irony there. And Olaf Scholz has a lot of political issues in Germany from the right and the left. And this kind of deal is just going to raise a lot more hackles in the German system.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
Countdown to the ECB. Rate cuts expected, but how guarded will the guidance be? Banking crackdown. China detains top investment bankers and asks others to hand in their passports. And a fresh cash injection. OpenAI seeks billions from investors, boosting the firm's value to $150 billion. Danny, good morning. Counting down to the ECB.
Counting down to the ECB, still living with the repercussions of a CPI that came in just ever so slightly stronger than expected. It's been a wild ride in this equity market. First, equities plunged 1.6% off the back of that. They recover to end up the day more than 1%. We're up again in the futures session, about 0.25%. The first time that we've gone down 1%, rebounded 1% since 2022. Meanwhile, 10-year yields under pressure again this morning, up by 2 basis points. You saw yields come up yesterday, breaking a 6-day streak of bond buying. Meanwhile, the euro, as you mentioned, Manus, it is ECB day. We're not really doing much this morning. We're at 110 on euro versus the dollar, just slightly stronger, Manus.
How to make that sound exciting. How to make the ECB sound exciting, Danny. But it's interesting. Goldman Sachs have actually lowered their terminal rate to around 2%. We've just had a conversation with Ludovic Subran, and he really was of the view they can take their time, even though Germany, as you say, is one breath away from a serious recession. You've got wages coming down, so that sort of meets the criteria for the ECB. It's a delicate balance on what Lagarde will say today.
Yeah. I just can't get over the fiscal problem that Europe is facing right now. You have Mario Draghi saying an immense amount of spending and borrowing needs to happen in order for us to remain competitive, and Europe is still squabbling over EV tariffs on China. They still can't figure that out. What does that bode for the wider European picture and for any sort of fiscal support once they do get the landing, if they can't even agree on something like that?
Well, we have seen Europe galvanize themselves in moments of extreme existential angst when it comes to the European debt crisis, etc. Moments of existential angst is what takes Europe to actually galvanize themselves. I don't think we're quite there over EVs just yet. But let's talk about the ECB and what's widely expected for the second time in 2024, and that is the decision coming along in less than a few hours. Let's get to Frankfurt, to our ECB reporter. It is Lizzie Burden. She's on the ground. So 25 basis points is assumed, but it's all about the destination. It's not the journey. It's the destination of where Lagarde wants to guide us to.
Not in life, but for the ECB, perhaps, yes, Manus. It's pretty much a done deal that we'll get a quarter point today because, as you say, inflation receding, the growth risks mounting. It's been pretty much unanimously endorsed by ECB speakers. So the focus on whether they can squeeze in another cut in October before sticking to this quarterly cadence of quarter point cuts all the way to 2.5% by this time next year. That's what economists expect. Markets a bit more aggressive, and this is going to be the focus, I think, of the press conference. But Christine Lagarde will want to be coy. She'll want to stick to the language of data dependence, not least because of the divergence on the Governing Council about where the neutral rate lies. But if she does pour cold water on an October cut, you could see a bit of a bounce to the euro. I'll also look to the forecasts for clues. Do they give a haircut to the 2024 growth outlook after that weaker than initially reported second quarter growth print? And does she emphasise the need to react more to growth than inflation risks? That's what Jan Hatzius at Goldman is talking about. He now sees consecutive cuts rather than at quarterly meetings. And he specifically calls out the growth picture, specifically the manufacturing weakness, and specifically in Germany.
Lizzie, the other important thing taking shape in Europe is a potentially transformational consolidation. UniCredit taking a stake in Commerzbank, by all accounts, with the intention to buy out Commerzbank. How much of this is it on the mind of an ECB, of a wider Europe that has for so long called for some sort of banking union in Europe?
I'm sure it'll be on the mind of Christine Lagarde today, Danny. I'm not sure whether it'll be on her lips, but journalists are going to ask her about it at the press conference. I reckon that her answers will stick to the principle of financial stability. Perhaps she will say that this is banking consolidation across Europe, something that they've talked about for a long time, that it sends a signal about the single market. But I would eat my hat if she talks specifically about the deal between UniCredit and Commerzbank. She would probably say, look, there are principles to follow in the sense that they've got to give early communication about a deal, there are rules to follow, and there are permissions that ECB has got to give. But I do not think she's going to get into the specifics today.
All right, Lizzie, thank you very much. 8:15 New York time is when we're going to get that decision. Bloomberg's Lizzie Burden. Now, from the ECB to the Fed and the dollar, Daragh Maher of HSBC weighs in on the dollar itself, writing this: the U.S. dollar's inability to capitalize on weak activity data outside of the U.S. suggests a market predilection for U.S. dollar weakness. The U.S. dollar has found a base, but it is languishing at levels inconsistent with the likely U.S. rate path, and more so in terms of relative economic merits. He joins us now. Daragh, thanks so much for coming in this morning. Great to see you.
Thanks for that.
I mean, what do you make of just this market bias for a weaker dollar, despite anemic growth in Europe, despite China being on its knees in terms of trying to get growth up there, and yet it is U.S. exceptionalism, a narrative that is evaporated?
Well, it is frankly weird, and the global FX market is just Fed fixated. That's it. I mean, that's the only conversation. You know, this whole 25 versus 50 nonsense, frankly, I've been like, we've always been in the 25 camp. I kept having frozen in my head that song going, let it go, the whole 50 thing, just let it go. And finally yesterday, they let it go. So that's nice. We've got that sorted. But no one talks about the ECB in the context of where should euro dollar be. It's just really quite weird. And, you know, as you say, European growth, Eurozone economic activity indicators, 10 weeks running, they've been coming in below expectations. Yesterday we had UK GDP, 0, and it's been 0 3 of the last 4 months. And yet people tell us, I'm worried about the US economy, which is running along at 2.5% in Q3 so far.
It's trucking along very nicely. Then explain to us and to the market why Eurodollar's at 110. Morgan Stanley, they've got a hell of a call. They're down at 102. So this probably chimes for you, which is a stronger dollar against sterling, against the euro, because this is a stronger economy, and the others may well have to outcut us.
I think so. And at the very least, the currency market has to take account of the fact that the others will be cutting rates as well as the Fed. And actually our economics team expect the Fed to cut by 175 basis points by the end of next year. But they also expect that the Bank of England will have cut 175 by then, that the ECB will have cut, and you know, it's all about relatives. It's like Christmas, Manus, right? It's all about relatives.
I love Christmas, Daragh.
Do you?
I
Good
love
man.
Christmas.
So do I.
And the relatives? I don't know.
Yeah, she's not. Danny's cage young relatives. So it all has to happen, right? So, and it's all happening at the same. So it's a bit of a wash. I liked what you said about euro this morning. It's a bit boring. Just before I came on, I looked at the consensus for euro dollar for a year's time, and it is higher. 0.2% higher. I mean, snooze fest. So look, we've got 105 on euro dollar. We've got 125 on cable. You know, and still comfortable with both those. But it's principally a dollar, not just a dollar call. It's also about euro. It's also about sterling.
When does it get to a point where we can't ignore euro anymore? You look at some of the political issues in Europe. VW, for example, talking about closing a plant in Germany when automaking is such a big part of this economy. When do these things become more of a macro issue? Well,
I thought it was interesting, you know, just before I came on, that you were talking about the European fiscal situation. I think that's completely underplayed in the currency market, right? I mean, my angle is slightly different because what I think is going to be sensitive is the Growth and Stability Pact is coming back with a vengeance, and you are going to constrain governments really in terms of their national flexibility around fiscal policy. And what does that do to an electorate that's already polarized in Europe, right? If you say to a government, if Brussels says to whomever, sorry lads, you need to behave differently, you need to cut spending, you need to raise taxes. I don't know, I think I could see a lot more political friction around that, which isn't manifest in euro as yet. And yet everyone's fixated on what does the US election mean for US fiscal policy. I think we need to start talking about European fiscal policy as well.
Well, those two policies, the US one is kicked into the long grass, really, isn't it, until next year, until we find out who is in charge. It's interesting, with TD with us last week, and they said, be more concerned about the outside world. You say the dollar is failing to capitalize on the weak data outside the United States. Where is the weakest? If we've talked about Europe, but where else is there that's a major headwind?
I think it's a collective thing, honestly, Manus. As you say, we've mentioned Europe. UK, I thought was looking a little bit better through the second quarter. We had reasonable GDP growth. Then they revised it down. Then they told us it was mostly government spending and inventories. And you're like, oh, really? That's not a great mix, right? China's still underwhelming. So it's hard. Where do you look globally and go, they're doing great, right? And so I guess the phrase I've used in the past is, even if we allow that the US economy is having a soft landing, which is kind of what you need, it's really Goldilocks with an American accent, right? And I've said that before, and I still think it holds. So it isn't a global soft landing, it's essentially US exceptionalism. Yeah. And then you're buying the dollar. It's not a global story of everyone landing it perfectly, economic resilience. It is a US story of Goldilocks.
Can I just go back to Europe for a moment and talking about sort of the fiscal impulse of it being, handed down from Brussels? You have Christian Lindner saying that we wouldn't agree to something like joint debt. We don't like this plan Mario Draghi does out. It should be every country for itself. We mentioned the EV tariffs, which, again, Spain is disagreeing with. How confident are you that we would actually have the ability of the EU to sort of enforce some of these fiscal rules more widely when you are starting to see these pockets of rebellion and politics dividing nations too?
It's been a long-running story in Europe, right, is that we don't have fiscal union, and that in a way complicates life for the ECB, for the euro. I still think it holds true. The enforcement of the Growth and Stability Pact has been patchy over the multiple years that it's been in play, right? And I think what's a little bit different now, though, is we've got a core economy, France, which is in the spotlight in that context. Previously, it was the periphery, and you could kind of north versus south bashing in Europe. That's not the case. So if you want a path to fiscal union, which is presumably what Draghi is suggesting we should be on, you need the Growth and Stability Pact to work, because you need that convergence of fiscal behaviour to be able to implement joint issuance.
Can we just round off? The one thing that came through with Ludo a little bit earlier on was the rate-cutting cycle here in the United States could be interrupted by the election, contested election, and the issues around that. That's his concern. So it's a slow-cutting cycle that can be interrupted. In terms of tail risk, how much is the election a tail risk for you? And where does the dollar function in that tail risk event?
I think at the moment people are talking about the election a lot, but they're not investing for the election a lot, right? They kind of want to know. They ask, well, what does it mean for the dollar? And you kind of give your multifaceted answer.
Are they asking you that a lot? Is that?
Yeah, they do. I mean, they don't expect me to have a clever answer, but they're polite. They ask. And I think the key will be, when does it get traction? I think now, we're beyond the 8-week mark. It feels like we're out of the phony game and into the real game for markets around the election. For me, the simple tailwind aspect is uncertainty. If you think the election's going to increase market volatility, get VIX higher, equities wobbling, the dollar should capitalize on that. And so I think the people who have snowplowed their 50 basis point call for September to November and to December, they're just going to have to let it go again. And that's it. I think we're on a 25 basis point cadence. We get 75 this year. We might get a 75, 100 next year, thereabouts. I'm not sure why we continue to sell the dollar.
I wish you had the rights to play Let It Go right now.
I know. We do sing it in the commercial break.
I'm waiting for Manus to sing it.
No. We did that once in our career. We won't be doing that. We won't be doing that twice. But I love the snow plies. And it's, 50 basis points. It's fading like snow off a ditch.
It is.
There you go. Daragh Maher, thank you very much from HSBC, our guest this morning on Markets. This is Bloomberg. It's Bloomberg Brief. I'm Manus Cranley alongside Danny Berger here in New York. OpenAI, they are back looking to raise $6.5 billion in equity financing from investors. The valuation on the ticket, $150 billion. That is a significant jump higher than earlier this year, when the company's tender offer put it at $86 billion. Tom McKenzie's tracking the story. Anybody who thought that AI was going to run out of valuation puff, they are sadly mistaken. So this is the next leg in the valuation for OpenAI. Tell us the latest on this milestone.
Yeah, look, as you say, from 86 billion earlier this year to 150 billion US dollars, looking to raise $6.5 billion. As you say, it suggests that the demand and the want of these investors to get exposure to this business, of course, the maker of ChatGPT, is still there. The backers, or at least those in discussion around raising and around funding this $6.5 billion, include Thrive Capital, but also, interestingly, of course, Microsoft, Nvidia, and Apple. Haven't confirmed yet, but they are looking at this. OpenAI are also considering a credit facility of about $5 billion, so they had financial firepower then on the back of this, about $11.5 billion US dollars. The CFO of OpenAI saying it will be spent on compute. So think GPUs from Nvidia, suggests the demand is still there for OpenAI, so it can be spent on compute and expenses. The business as well, OpenAI, also hoping that they can return some capital to their employees later this year, allow them to sell some of their shares as well, and it could give them the options, or at least the liquidity, to be able to do that.
Tom, we also had this Goldman Sachs tech conference in San Francisco yesterday that the Nvidia CEO Jensen Huang spoke at. After he spoke, shares were up some 8% on the day. He was talking about things getting tense with the company's customers. This is what he had to say.
Delivery of our components and our technology and our infrastructure and software is really emotional for people, because it directly affects their revenues, it directly affects their competitiveness. And so we probably have more emotional customers today.
I mean, what a way to describe it. It's getting emotional. The conversation has been, are these companies getting a return on investment? Does this signify that it doesn't even matter, that they're just so emotional, they need to buy the chips anyway?
Look, he really stressed this emotion, didn't he? I think in one soundbite he said the word emotional about four or five times. So it's a colourful way of framing, as you say, the tightness in this market and the fact that the demand is still there. He says the demand and the supply is still not able to match that demand. And of course, they design the chips, but the company that actually churns the physical product out, the GPUs, is TSMC over in Taiwan. He again extolled the virtues of that company, but clearly there's catch-up that's needed to be able to produce these GPUs to match that demand. He also said the future GPU coming in later this year, the Blackwell, he's seeing strong demand for that as well from their customers. You rightly point to the question around ROI. Top of mind, of course, for those investing in the AI space, or Gen AI space, Danny. And he gave a few numbers on that. Interestingly, he pushed back on the idea that there wasn't ROI. He said, look, if you're a hyperscaler, so a Microsoft or an Amazon, if you're buying these GPUs, putting them to a data center, you might spend $1, but you're going to get $5 upside on the value of renting out those data centers, those servers, those data centers, I should say, to your customers. And then if you're one of those companies renting that space, then you're going to see a massive pickup in terms of efficiency, he says, as a result of shifting from the compute that we have now to accelerated compute efficiency of up to 20x. That was at least the detail coming from Jensen Huang. So really trying to make the case that there is still ROI to be had in investing around GPUs.
Yeah, really an attempt to pour cold water over that. Tom, thanks so much. Bloomberg's Tom McKenzie. Okay, elsewhere in the U.S., two of Wall Street's biggest banks are rolling out measures that may ease junior bankers' workloads. There's been complaints across the industry that weekly hours are creeping past 100. So, Manus, the details. Bank of America is going to have a new internal platform, and that will more closely monitor individual workloads. It's the so-called banking diary. And then at J.P. Morgan, they're going to limit junior banking hours to 80 per week in most cases.
Look, this comes down to deal flow as well, and an industry that wants to be seen to be responsible for their staff. You had a young banker at Bank of America who died suddenly, and I think that sort of brought into the consciousness about, well, what are your young bankers doing? But look at the deal flow. The deal flow spike in the first 6 months of the year relative to where we are now, just coming off the boil. So in some ways, the marketplace itself is helping them, as it were, look after the staff a little bit more for now. But you can be sure, as soon as that deal flow flips to the upside, the expectations are going to rise again.
I was going to say, I have a really hard time believing that they'll actually stick to this. So just take J.P. Morgan as the case study, for example, right? They say, OK, only 80 hours per week, unless there's an exceptional circumstance. How often do you think MDs are going to find exceptional circumstances to get their employees to work more? And you have cases, for example, at Bakes, where they've tried to limit hours, saying if you go to 100 hours a week, you know, use all these red flags. A bunch of junior bankers talked to Bloomberg back over the summer and said that they've been basically lying in their work logs because they didn't want it flagged to HR. So yeah, they can say all these niceties, but in practice, does it really happen?
Look, the bottom line is, if you want to get to the top of this pile, you know, it is a competition. It is a competition, and it's in terms of delivery. So on the one side, you have these gestures, but the reality is, if you want to be the top of the bonus pile and the top producer, I assure you, from vicious personal experience, it means you work a little bit harder than your peers on the desk.
And they're all scared of being replaced by AI too. So there's that.
AI is supposed to come along and possibly help them all.
They lose their jobs.
No, AI's coming after their IQ rather than their EQ. I think that's a line from Larry Summers. But look, the AI is supposed to help them do some of the grunt work as well, in terms of the analytics.
Yeah.
In theory.
Well, Citi said that some of their junior bankers would be replaced by AI if things go according to plan.
Don't go to Citi. There you go. Look, it's going to be an industry issue. Let's talk a little bit about China, because, again, there's a little bit more heat turning up in China in terms of their investment bankers. 8,700 to be precise. Now, at least 3 executives from different securities firms have been detained by Chinese authorities since August, sending pretty much a chill through the industry. So that is one story to keep an eye on that's evolving. We'll take you through the rest of the trading day. We're setting up for the ECB rate decision and the press conference from Christine Lagarde on Bloomberg.
It's Bloomberg Brief. Danny Berger alongside Manus Cranny in New York. Let's get you set up for your trading day. The ECB will announce its rate decision at 8:15 a.m. Eastern. Then there will be a press conference from President Christine Lagarde at 8:45 a.m. Then we're going to get some more economic data. We get another round of jobless claims. PPI also comes out. That's at 8:30 a.m. And then some earnings with Kroger before the bell and Adobe after the bell. Manus.
Yeah, Danny, it's interesting how we've had 2 conversations, both with Ludo and with Daragh from HSBC, basically saying, get rid of your snowplow, your obsession with this 50 basis point jumbo rate cut. Stop pushing it forward, stop obsessing about it. It's not needed, it's not necessary, and just lose it. And I think to a certain extent, you know, the rates market sort of heard that yesterday. The equity market just ploughed on, excuse the pun, higher on tech, really.
Yeah, well, which is maybe good because the equity market's been so negative recently, but it has been a market that's more willing to price in U.S. downside. This is something that Daragh talked about that I think is interesting. Man, should we look at some photos of space?
A little bit of calm.
A little bit of calm.
Take us into surveillance.
Decisions. Okay, so what you're looking at is the SpaceX Doris Dawn crew. They're getting ready for a spacewalk to test out the new spacesuits. You're going to have the billionaire Jared Isaacman and Sarah Gillis, the 2 who get to do it.
Yeah, it's going to be 2 hours from top to tail. I mean, the main goal of this is to test the suits that have been developed inside. We'll leave you with a live shot.